The stream is still going. God, this is the warm-up. Okay, so let's get into this. First thing I see here, without looking at any of the research, without looking at any of the outlooks, any of the expectations, anything that anybody else wants to influence us on as far as trading goes. First thing I see is we have a gap trade. And by a gap trade, most people think of these price literally gaps like this. When I'm using these indicators, I'm looking at probability gaps. The probability gap is the space between two peaks in this distribution of the indicator called range probabilities. We're looking at this peak here, which says throughout the chart's history, there's been a cluster of tops for the month right around here relative to the open. Same thing with here, same thing with here. Oh, there we go. And now in between these peaks are your troughs where you get lower probabilities. You can see the exact probabilities on the right-hand side. So you can see the numbers here are highlighted and larger than the numbers right here. And then these numbers are large. So these generate your peaks, these generate your troughs. And right here we have quite a wide trough. Oh, delete all of these drawings. So now that we know where the peaks and the troughs are, what's this gap? The idea is like a breakout, except when price starts moving up into these lower probability areas, you set the expectation that we're going to move to the next highest probability spot. So if we do set an expectation where the dollar yen goes higher, the expectation should be, hey, this whole area, this whole trough, we're going to trade and then go up, trade, make the top for the month around here, and then probably go down. Or if there's enough fiscal stimulatory expectations out of the yen, we could then go into nowhere's land, and this is all tail risk. That's the tail of the distribution. We can draw a line and say at this red line, that's where we get the threshold between when we start experiencing more significant likelihoods of seeing really far off, really super high, above 160 tail risk pricing. Should dollar yen have a sharp reaction and test 160, one can expect intervention in the FX markets. Conveniently, Wednesday, February 11th is a holiday in Japan, which offers less liquid markets and an opportune movement to intervene. So imagine the people who are going to watch the Super Bowl on Sunday and didn't spend any time doing their proper research. They're going to be scrambling after Takaichi likely wins. And if she gets that majority, it's going to send dollar yen higher, and everyone's going to be like, oh, that's hunky-dory. Oh, everything's all well and good. And then because they didn't read any research, they're not going to know about this risk on the Japanese holiday of February 11th. People who follow the Bank of Japan and the Ministry of Finance know this is a common occurrence, that they try and do interventions. I remember explicitly a handful of times this exact scenario has happened before, where interventions come in proximity to holidays because they cannot intervene. That everything closes during the holidays. They can't intervene, so they get the intervention done before markets have to totally shut down and potentially run away when they cannot intervene. So they do a preemptive intervention beforehand. Now, those prior times that I recall were more intense intervention periods. I'll just say when dollar yen like really moved 200, 300, 400, 500 pips in really quick succession. And it was completely expected. I would say this is not the nominal consensus expectation, is that they will intervene on February 11th, but understanding this risk is part of the research. This is the main issue. This is what you have to know. This is why we read outlooks from different institutions. Should the US Treasury choose to participate in spot interventions, it will naturally play out as a broad US dollar negative, as it involves printing dollars to attain a foreign currency, in this case the yen. Hard for euro to break out with yen weakening. Fed rate check in dollar-yen speculation. Fed to print dollars to print yen. This would probably send euro-dollar way back above 120. There's a baseline consensus expectation that the dollar should be getting weaker this year. It's like pulling teeth trying to get these analysts to say, what is the catalyst? What are the exact risks? What are the days? What are the economic events? What specific things could be the catalysts if our expectations are over the trend of 2026 to go above 120 on euro dollar? What are the dates? What are the potential catalysts? A major one off the top of my head that I know about, that a lot of people talk about, is the tariff risk of the U.S. Supreme Court go ahead and decides that the tariffs that Trump put on are unconstitutional, and then Trump has to do this massive payback. Yeah, that'd be a huge deal. That would probably be one of the catalysts to send your dollar way up really high. Dollar would massively inflate at that point. That'd be a big deal. And we're still watching that in the research thread. Right now, the Supreme Court is on hiatus. They're not going to be making a decision on it for another few weeks. I think not until late February, early March, we can relax on that specific catalyst. The main cause for dollar-yen outlook is that Takaichi achieves a comfortable majority following the yen weakness, but also intervention. February 11th, an opportune day, as discussed above. However, after that, the risk premium in yen falls and dollar-yen tracks the path for yields. So these are the different scenarios here. So this one in dark green here, big majority and intervention. And then this one in black, where you're going like to, what's that, 163? Super majority and intervention. The results of the Japanese general election will shape expectations for fiscal policy, particularly the feasibility of a consumption tax cut. This seems to be one of the primary things, other than defense spending, because people want deterrence against China. Other than that, the more China says anti-Japan stuff, the higher Takaichi goes in the polls. Because she's saying we need to continue rebuilding the military and spending on defense. This drives popularity with people. That message resonates with. The vote has direct implications for the political standing of Prime Minister Takaichi, increasing the risk of heightened market volatility once results are confirmed on February 9th. A recovery in LDP support, which is Takaichi's party, would reinforce the Takaichi trade, reflecting expectations of a more stable political base and a tilt towards expansionary fiscal policy, including the prospect of tax cuts. Very good. Well, let's go ahead and check this out, because I remember this being particularly interesting. Budget deliberations for the next fiscal year in Japan are likely to get underway relatively quickly after the election. So we're immediately going to get hit with a bunch of discussions about where money should be spent fiscally over the next few months, likely into the summer. Assuming no change of government, bringing proposed consumption tax cuts back into focus. All right. The LDP's manifesto adopts the same approach, pledging to advance discussions with the National Coalition on funding and scheduling a 2-year tax exemption for food and beverages. I wonder if that includes alcohol. Consumption tax revenue remains a core funding source for Social Security programs, such as pensions, and that opposition to tax cuts are still entrenched within the LDP. So we'll see. Hopefully this doesn't end up hurting Japanese Social Security. we have a geopolitical catalyst, the general election in Japan. If Takaichi gets a big majority and we get intervention on February 11th, the holiday, we can end up with reasonably going to that price. If we actually end up with something more akin to getting a supermajority, oh my god, that actually really would be a supermajority, because they only need about 150 seats in order to start appointing people again with their coalition partner. They need about 150 seats combined to form the majority government and start putting people in charge of commissions in Japan. That's how they can get stuff done. Takaichi can have success. She at least needs about 150. And some of the polls that are saying 300, it's hard to believe. But in the scenario where you do have that surprise, you're going to see this black line here, supermajority / intervention, really high move. So you're talking 162, 163 on a dollar-yen chart. And that is just going to totally blow away expectations. At that point, you're talking about going up, up, and away. You're talking about trading way up here. So that's the review of what we know so far. We've now done the research. We've collected our research. We've read our research. We've found the important bits. Those are the important charts that we wanted to look at. Now we use the indicators to price things. Around here, this is the threshold for trading up until we get into this area. Once we break higher, we're dealing with prices in the 162s, the 163s potentially. If you get intervention, you're going to have a snap back. You can't just focus on the upside. You're just going to end up ignoring all the things saying, hey, they're going to intervene. The BoJ is going to intervene. They're going to intervene if this goes high enough. You're just going to get totally ruined. Pay attention to when the BoJ says, we don't want this thing to go that high. There's a clear catalyst with Takaichi. If she wins and she gets a majority, she's able to get into government, this is probably going to go up to 160. If Takaichi gets a supermajority, this could very easily go past 161. And then when the yen is moving that far up, that far fast, going into February 11th, which is a holiday, the Bank of Japan probably is going to tell the US Treasury, hey, please buy some yen, so we can stabilize our currency here. Trump endorses Japan's Iron Lady ahead of Sunday election. This was February the 5th. Look how happy she is with Trump. Dude, this is a great thumbnail. I think I found the live stream thumbnail. Japan's first female leader, inspired by Britain's Thatcher. Trump invites Takaichi at White House on March 19th. We got to put that on the chart, guys. March 19th, Trump invites Takaichi to the White House on March 19th. US President Donald Trump gave his total endorsement to Prime Minister Takaichi ahead of the national election in Japan on Sunday, adding he looked forward to meeting with her at the White House next month. This is gonna be a big deal. Now, we're not gonna go into these articles too deep. All right, beef with Beijing. So remember how I said, hey, one of the major reasons why people are supporting Takaichi is because China's been a bit more aggressive in their communication style with the Japanese. A resounding victory could hand Takaichi new clout in an escalating dispute with powerful neighbor China. Current and former Japanese officials said, though Beijing has shown no signs of backing down. Weeks after taking office, Takaichi touched off the biggest dispute with China in over a decade by outlining how Tokyo might respond to a Chinese attack on Taiwan. A strong mandate could also accelerate Takaichi's plans to bolster Japan's military, drawing more anger from Beijing, which has cast her endeavors as an attempt to revive Japan's militaristic past. And this is a big reason why people are still deciding to vote for her. Because there's a lot of people in Japan who want a prime minister who can stand up to China for Japan's interests. Former Japan currency chief says FX intervention should be backed by rate hikes. Intervention using Japan's foreign exchange reserves can deliver an immediate jolt to markets, but its impact would be more durable if accompanied by steady rate hikes, a top informer. Let's see here. What's the quote? Intervention using actual funds can have a strong impact on markets, but its effects will be more lasting if the Bank of Japan also demonstrates a clear commitment to steadily raising interest rates. He wants rate hikes when there's intervention going on. By responding appropriately to inflation through rate hikes, it may also be possible to curb excessive jumps in long-term government bond yields. That is the useful part. What's the rationale for hiking? That you don't want to see long-term bond yields go and float away. Inflate away. That is all the fat lady said.